The distinction between shares and stocks can be a little hazy as investors often use them interchangeably when discussing the stock market. In short, shares are the unit investors invest in a company, while stock refers to the company that issues the shares. Usually, stocks and shares refer to the same thing. However, there are times when it's necessary to use the terms based on their correct definitions. Thus, understanding the difference between a stock and a share may provide a more nuanced look at investing. The differences between stocks and shares are subtle, but important to understand when you are investing. A stock is the actual asset in which you invest, while a share is the unit of measurement for that asset. So, a stock tells you what you're investing in, and a share tells you how much of that stock you own. Stocks, also called equities, are a type of security that gives investors a stake in a publicly traded company. A publicly traded company trades on a stock exchange, like the New York Stock Exchange or Nasdaq. When you buy stock, you buy a share or fractional shares of a publicly traded company. You essentially own a small piece of the company, hoping to get a return on your investment. Companies typically issue stock to raise capital. Usually, the goal is to grow the business or launch a new product, but the company can also use the money to pay off debts or for another purpose. Generally, people buy stocks with the hope that the company they invest in will earn money, and as a result, the investor will earn a return. There are two ways to earn money through stock ownership: dividends and capital appreciation. Dividends are payouts made by a company to its shareholders. When a company is profitable, it can choose to share some of its profits with its shareholders through dividend payments. Typically, companies pay dividends on a specified schedule, although they can pay them at any time. The second way to earn money is through capital appreciation, which is when a stock's price increases above the purchase price. However, capital appreciation doesn't lock in your gains. You don't realize your profits until you sell your stock. When you sell stock and realize a profit, you must pay capital gains taxes on the windfall. Beyond common and preferred stocks, investors can buy and sell many different types of stocks. Usually, investors break down the various categories of stocks based on investing styles and company size, among other factors. By different styles of investing, investors may divide up stocks of different companies into value and growth stocks. Growth stocks have the potential for high earnings that may outpace the market. Growth stocks don't usually pay dividends, so investors looking at these stocks hope to make money through capital gains when they sell their shares after the price increases. Growth stocks are often tech, biotech, and some consumer discretionary companies. As the name suggests, consumer discretionary companies sell goods or services that consumers don't consider essential. Value stocks, in contrast, are stocks that investors consider to be trading below a price that accurately reflects the company's strength. Value stocks usually have a lower price-to-earnings ratio. A share is a piece of the company an investor can own. A share is a unit of ownership, e.g., you own 10 shares, whereas stock is a measurement of equity, e.g., you own 10% of the company. Think of shares as a small portion of a company. So, if a company were a pie, a share would be a slice of said pie. The more slices, the more shares. Shares play a role when calculating a company's market cap. To find the market cap of a publicly traded company, you multiply the stock's price by the number of outstanding shares, which is the number of shares currently owned by shareholders. This can also be referred to as shares outstanding, and the exact number can fluctuate over time. Changes in the number of shares available can occur for various reasons. For example, if a company decides to release more shares to the public, the number of shares would increase. A stock split is a decision made by the board of directors of a company to adjust the price of their stock without changing the company's overall value. It is one of the ways how the number of a company's outstanding shares can change. The company usually initiates the stock split when its stock price gets too high. For example, if a company's stock is trading at over $1,000, it can be difficult for some investors to purchase and limits the availability of buyers. To remedy this problem, a company will issue new shares through stock split, lowering the price of each share but maintaining its market cap. A 10-for-1 stock split, for instance, would exchange one share worth $1,000 into 10 shares, each worth $100. Your total investment value remains the same, but the number of shares you own increases. Trading company stocks or shares isn't the only option for investing. One alternative is to invest in shares of a mutual fund, a managed investment fund that pools money from several different investors. The money is then invested in various securities, including stocks and bonds. Another option for investors is exchange-traded funds, ETFs, like mutual funds. ETF are baskets of securities packaged into a single investment vehicle. But unlike mutual funds, investors can trade shares of ETF all day in the stock market. One significant benefit that mutual funds and ETF offer is portfolio diversification. A mutual fund and ETF can either be actively managed by a financial professional or passively managed, which means the fund tracks an index like the S&P 500. The main difference between stocks and shares is that a share represents a unit of ownership in a company, while stocks refer to the ownership of one or more companies. However, most people use these terms interchangeably in regular conversion, but knowing the distinction between the two terms can help you better understand the stock market and investing. When you're ready to jump into the stock market and start trading stocks online, consider SoFi InvestBar. SoFi's online brokerage account allows users to buy and sell company stocks, ETFs, and fractional shares with no commissions. For a limited time, funding an account gives you the opportunity to win up to $1,000 in the stock of your choice. All you have to do is open and fund a SoFi Invest account. We are almost wrapping up. These are the common differences between these two. Hope you like this video. Please comment, share, and subscribe to this channel for more videos.